what you want to do is you want to try to minimize the amount of cash that you're paying in taxes every year. And the best thing for anybody to do is to plan ahead. There is so much more that you can do with your tax situation before the end of the year than you can afterwards. So now is really the time to really be making those important decisions on what you're going to do prior to year end to try to reduce or minimize your tax liability. Einstein once said that the hardest thing in the world to understand are income taxes. Now, I mean, I don't think that's the case, but I mean, there are a lot of people out there that are you know, it's just voluminous. You know, there's over 70,000 pages in the U.S. tax code, which there was in 2013 when it first started, there was about 400 pages. I did a little calculation. It would take you almost 9 months without sleeping to read all the tax code. No sleeping, and you'd have to be a speed reader almost to get through it. But what I'd like to do for you today is try to simplify the tax reform that took place. We'll go through a few summary of the tax changes, as well as go through one of the more important tax changes I think that was done is Section 199, and you may have all heard of this. It's the qualified business income deduction, which is a 20% deduction just for generating income, and we'll go over that. Then we'll also go through some 2018 tax planning. This is a very condensed kind of thing. I'm going to give you a few tips and some things that you might do prior to the end of the year, but it would take a little bit more than that. And if it's something that you want to do on your own, I've got some resources to help you to do that. So with that, we'll move to the kind of the summary of things that took place with the new Tax Cuts and Jobs Act. The first thing being here on the top here is the child tax credit. I don't know how many of you all have kids or not, but what they did is they increased the credit from $1,000 to $2,000, which should help out quite a few families. You know, we'll go into more detail in what that's all about, but the next thing there is the individual tax rates were reduced in the brackets. They kind of went kind of sporadic on how they reduced the rates from the different tax brackets. We'll go through that more in detail, but you see there, here's where the prior law was. You know, you had a 10% tax bracket, and then you stepped up to 15. You'll see here with the new law, it went down. It's still 10 in the first bracket, but it went down to 12. And then about 2 or 3% for each bracket. We'll cover that. I'll show you some of the differences there. They did increase the standard deductions. So each person, depending on their situation, gets a standard deduction. And you normally use that is if your itemized deductions are less than that. They did double the standard deductions, which is a big increase. But what they did do is they eliminated the exemption, the personal exemption. So before, for each individual, there was a exemption that you got for each dependent in your family. It was about $4,300. Now they have eliminated that, but they've done some other things to kind of help taxpayers get around that. The next thing there you'll see is the corporate tax rate was reduced. Those are for the bigger corporations, the C corporations. They reduced it from a 35% max rate down to 21%. It's about a 14% decrease. But not only did they do they help out the big businesses, but they actually did a great thing helping reduce taxes for the smaller business with the pass-through income qualified business deduction. And we'll talk about that in more detail here in a little bit. It's a 20% deduction. AMT was the exemptions amounts were increased, so you're not going to pay AMT taxes with smaller amounts of income. You'll have to hit different thresholds to hit those AMT taxes. And then, like I said, the personal exemptions, those were eliminated. State and local taxes, that was a big change. Nowadays, now you're only going to be able to deduct up to $10,000 of your state income tax, your combined state income tax, personal property taxes, and real estate taxes. So that was one thing they did that could hurt some people that are paying more than $10,000 in taxes.
The $10,000 was real estate taxes.
Yeah, it's real estate taxes, income taxes, and personal property taxes. And if you paid sales tax and you want to use that in lieu of those, it's $10,000. So it's those 4 taxes that they put a cap on that you could reduce. And then finally on this summary here, the mortgage interest deduction. Now you're only able to write off the interest on a mortgage of $750,000 or less, where before it was $1 million limit. And this only pertains to debt that was incurred after December 31st, 2017. So if you got a mortgage prior to that was more than $750,000, you're okay. So there's no change there. But once you refinance or buy a new home, the new limit would kick in there.
And that was a question I've been having, and that went into effect, what was the cutoff date?
December 31st of last year, 2017.
So if you had a mortgage of $1 million, can you count the interest up to $750,000?
Well, if you had a mortgage of $1 million prior to then, you could go all the way up to the $1 million and take the interest on the $1 million.
But you originated it in 2018.
But if you originated it in 2018, the $750,000 limit applies.
So you can't, if it's $1 million mortgage, you can't deduct the interest for $700,000.
Yes, you can. You could still deduct 3/4
Yeah.
of
Gotcha.
the,
Okay.
or whatever it is,
750,
whatever.
right.
Right, it's the part over
I
750.
seem to be reading contradictory things. So,
No.
but you can.
Yes, you
Okay.
can.
Okay.
Yes, you can.
How would, do they report that differently then?
You know,
From the mortgage companies?
I don't know if you've noticed on your past 1098s, but they do put in the amount of your loan at the end of the year. So they may be able to come up with an average if they have the beginning of the year, ending the year. So they do report your principal loan balance on their on the 1098. So yes, they do, and they have been doing that in the past already because of the higher limit. So yes, they do report that. But this is just a summary. This is just a few things. I'm going to get into some more detail here. First here being is the tax reform brackets. You'll see here, these are last year's brackets. And the income brackets really didn't change much at all. They just went up a little bit for inflation. So you see here, for a single taxpayer, the 10% bracket was any income from $0 to $9,325. It just went up $200, that bracket. The difference is, what you see is the rates in the next brackets. This went down 3% for your brackets between $9,500 and $38,000 for single filers, and for married filing joint, for these brackets here, $19,000 to $77,000. They did adjust for inflation there, but it's the same brackets, just different rates that they enacted. So that's one of the things that took place. That there, I mean, if you're using TurboTax or your accountant should know that. If TurboTax, it should calculate that right into the tax forms if you're doing it on your own. So there's really no planning there to think about other than when you're coming up with your estimates prior to your end. The other thing that I talked about was the standard deduction. It increased quite a bit, and so I don't know if you guys are familiar with the standard deduction. There's 2 ways that you can deduct some of your personal expenses. One is the standard deduction, and if you have more than like $24,000 in itemized deductions, and those itemized deductions being taxes that you pay, mortgage interest, charitable contributions, medical expenses. If they're more than these thresholds here, then you'd itemize, or you do the Schedule A. This is really going to create it's going to be a lot easier, I think, for a lot of taxpayers, because I think most taxpayers, they're probably going to be under that amount, so you won't really have to itemize. But there's some things that you could maybe do where, and we'll talk about later, where you could maybe maybe pay some taxes up front, or pay some of your your charitable contributions up front, to maybe 1 year be able to deduct your itemized deductions, and maybe the next year you take the standard deduction. And by doing that, you may be able to deduct more than you would if you just took the itemized or the standard deduction. Okay, but for this here, singles standard deduction went up $5,600. Married filing jointly went up $11,300. It pretty much doubled across the board. Is what they did. They doubled it. So this should be a big savings, especially if you have if you're not itemizing now anyway, right? Or if you have a small mortgage where you don't have a lot of interest. Maybe you were right on the cutoff. You're just maybe a little over 12,000 in years past. This is going to be a huge tax savings for you if you were in that situation.
Any changes to the health threshold? Is it 10% still?
Yeah, they did change it back up to 10%. So they did up that from 7.5.
Raise the threshold.
Yep, from anything over and above AGI from 7.5% to 10%, and I'll talk about that here in a second. And then you'll see there below the personal exemptions repealed. They took away the personal exemptions for your dependents, and so that's one thing. So that if anything that hurts most people, but there's some other things that will go on here that could definitely help you. So the first thing here is the child tax credit. Anybody with kids in here, 17 and under? Good. So that's a good thing for you. They did increase the child tax credit from $1,000 to $2,000, with $1,400 being refundable that you can get back in a refund. The other $600 would reduce your tax liability.
Is it 17 and under or under?
It is. So it would be 16 and under. So it's under 17. So once you hit 17, sorry if I said that wrong, but you're right. If you're 17, you don't get that. However, they've enacted the new family tax credit, which is new for dependents and children that are in school, that are in. So what they did was they are giving you credit for those kids. They're going to give you a $500 credit for kids that are in college that aren't living with you from ages over 16 through 23. So that's something that wasn't there in the past. So if you had a 17, 18-year-old at home, you weren't able to get that child tax credit. Now you will be able to do that. And then also you can get a tax credit for individuals in your home or dependents that aren't your children. And there's a list of them there: grandchild, siblings, stepbrothers, stepfathers, your grandmother, son-in-law. Those type of individuals that are living in your home, you can be eligible to get a $500 credit for those. Now, they really did up the phase-out amounts for these. So if you're married, these don't start phasing out until you hit like $400,000 of income. So this should apply for most people. So you should get a $500 credit for your kids, even if they are 17 or older and at school up to the age of 23. So it's a good piece of reform, I think. It helps, definitely helps with the eliminating the personal exemption amount that we just talked about. Okay, so here's some more itemized deductions. Now, before I talked about, they upped the standard deduction, right, from 12 to 24,000 if you're married filing joint. If you have more than the standard deduction, then you can start itemizing. And these are the type of expenses that you would have in order to itemize. The first one being the state and local tax deduction. Again, that they put a cap on that, so they capped it at $10,000. There's some things that you can do there if you want to try to maximize that or stay under it. One of the things that you can do is you could pay your property taxes up front to maximize that. So, for instance,
For the year?
Yeah, you could for the year. So, like if you're under 10,000, that might be something that you can do. Prior to the end of the year, paying your property taxes, that could get you up closer to 10,000. But you don't want to go, you don't want to go over that. So that's one thing that took place. The mortgage interest deduction, we talked about that. They reduced the amount that you can claim as a deduction for incomes debt up to $750,000. That was $1 million before. The home equity interest deduction. We haven't talked about this yet. They have done away with the home equity interest deduction for any amounts that you take out of home equity line that aren't for your principal residence. So if you go out and you take out a home equity line of credit and you pay to pay off your credit cards, that interest will not be deductible. Now,
How in the world would they monitor that use
That's
of the money?
that's a great question.
I mean,
It's
not
on the
that
honor system. It really is on the honor system. So
Not that I'm gonna create fraud, but I mean,
Yeah.
seriously, how could that ever be monitored?
I mean, right now there isn't a way to do it. I mean, it really is on the honor system. Now that doesn't mean you still can't deduct it for other reasons than that. If you're going to invest in, say, a business, right? You could use that. You're paying interest to start a business using a home equity line of credit. You could still deduct those expenses, that interest expense, but you couldn't do it on your personal tax return or your itemized deductions. You would have to put it either on your Schedule C, or if you're a sole proprietor, or you'd have to put it on your business tax return. Okay, so that there is a way. If you're using it for business, that is one way that you could do it. It just depends on your situation and how you account for it. But there is some ways around that. The other thing is for investment purposes. The other one is investment purposes. So if you want to take out some money to invest in a REIT or something like that, or some sort of, maybe you want to invest in the stock market. That interest there then would be an investment interest. So then you can deduct that further down on the Schedule A as an investment expense. So there's still ways to be able to deduct that, even if it's not for your personal residence or for improvements. You just got to think outside the box a little bit there. But definitely you could do it for business or for investment purposes. And here's one here, the next one there, the medical deduction. It's for qualified medical expenses that you're deductible.
What's a qualified?
So I mean, they're expenses that aren't reimbursed, right? They aren't paid for. They come out of your own pocket.
Right. Insurance.
So the insurance isn't covering it. Yeah.
Including premiums that are taken out before tax.
Yeah, that's insurance. Yeah, that still fits in the medical expense section. So yes, insurance. Yes. But what they've done is they've reduced the threshold from 10% of AGI down to 7.5%. So that definitely should help some taxpayers there by reducing that threshold.
What's AGI?
So it's your adjusted gross income.
Oh, thank you.
So it's your income from all sources less deductions for, say, an IRA contribution or maybe half of your self-employment tax. It's your income after those deductions. They did away with the personal casualty and theft loss deduction. And what that was for is, say, for instance, you got into an auto accident or something, damaged your car, maybe your insurance didn't pay for the entire loss. At that point, you would have been able to deduct the portion that your insurance didn't cover. They did away with that unless it's something that the president has deemed a disaster area. Okay, so if you were hit by a hurricane or something like that, had a river loss, that still does qualify for this deduction. But they did do away with that. And then another one, finally, on the itemized deduction, the charitable contribution deduction. They did do something good here. They raised the limit of how much you can deduct from 50% up to 60% of your income. So, for instance, if you made $100,000 of income prior, you were only able to deduct up to $50,000 in charitable contributions. Now you can deduct up to 60,000 or 60%. I mean, you'd have to be a pretty generous person to have to reach those levels, but they did do something there. So those are some things that took place in the itemized deduction area as far as tax reform is concerned. This next one is a little more juicy, and I'm thinking this is probably why most of you came here today, was the qualified business deduction, the 20% deduction. It's in the IRS code. It's called a Section 199A deduction now, and this is a new deduction for all pass-through business entities. Now, I got a good question earlier. Pass-through entity, do you have to be an LLC or an S Corp? No, you do not. You can be a sole proprietor, and a sole proprietor still fit into the definitions of being a pass-through entity. And the way this works is for the next 7 years, from 2018 to 2025, 7 or 8 years, let's say 8, I think it's 8. This is a new deduction. This has never been done before, and this was done in lieu of the reduced rate for big corporations from 34 to 21. This was done in lieu of this, and the way it works is you take your total gross income less your expenses. All right. So say for instance you made $100,000. You had say 50,000 expenses. Your net income is your qualified business income. What this new law says you can do is take a deduction for nothing. It's really not any expense or anything. It's really a deduction for 20% of that income. So you get an extra $10,000 deduction in that example to help reduce your taxes. So in that scenario there, if you're in like a 25% tax bracket, that right there alone would be about $2,500 for federal purposes and say 5% for state. That's a $3,000 tax break there. For this one deduction. So it's a big thing, and you don't want to miss out on this one here. I will say this though, if you look down there at the bottom, certain personal services are not eligible for this, and realtors fit into that description.
What?
I know. If you say there, unless their taxable income, unless their taxable income is less than $157,000 if you're single, or $315,000 if you're married. Okay.
Oh.
So if you make under those amounts there, right, you're still eligible for it. When they first started putting this together, they were trying to eliminate all personal services, so you wouldn't have gotten this deduction. This was a last-minute thing that they got put into the tax reform. So I know when I said it's not eligible, it's only you're not eligible if you're making more than these amounts here. Okay. So
could they have worded that any more?
Yeah, I know they exactly.
difficult?
Yeah.
Right. So
Those
Double
adjusted,
negatives.
those numbers, 157 and
Could have been much
315.
for inflation, they get adjusted for.
No, they.
Oh yes, yes. Well, actually, this is even more so. It's taxable income, so it's even better. So
Okay.
less your itemized deductions or standard deduction. It's what's taxable. So it's even better.
That 157 would be based on your net qualified business.
That would be based on it's your taxable income. So it would be all your income sources, less your deductions, and once you get down, your itemized deductions or your standard deductions, whatever you take, less those, this is then the threshold. So it's whatever you're paying, the income that you're paying tax on. So it's still a pretty good sized number. Most people, most small businesses should fit in there. Once you get over these amounts, there still is ways that you can still deduct it, but you have to pay yourself at least 50% of your net income in wages. So there is still ways to do it, but you have to pay yourself a considerable wage. It's a big deal. It's something that you want to try to plan for. And when I say plan for, you might not be having to make as much in estimated tax payments throughout the year or withholding on your paycheck. That's one thing that you don't want to do for the government is give them a free loan. And so this is something that you might want to think ahead on. It is nice to get a refund at the end of the year. I know it's really nice, but if there's something that you can do prior to then to try to reduce the amount that you're withholding or whatnot to not give the government a free loan, this is one thing that you might want to think about. And it's definitely a big change versus last year. So I'm pretty happy with this one here. This is great. I think this is going to be great for small business. And it's going to be around for quite a while. Are there any questions on this part of it here, the qualified business deduction? And if you have questions later, you can ask them later. But this is one I thought you guys would be interested in.
So it's really just, it's the net on your Schedule C, and if you were a sole proprietor, it would be the net income on Schedule
Yeah, so
C,
for instance, on a
and-
Schedule C, you have all your commissions, that was your revenue, and then you have all your expenses, you have your fees for advertising, your auto expenses, your office supplies, you might have some depreciation, home office deduction, and whatever's left over, out of that would be your qualified business income. You take 20% of that piece, and that would be a deduction that you would get.
And is that
Did they-
deducted on C or 10?
It would be on your 1040.
Okay.
It would be on your schedule, your 1040.
Did they take away some of those deductions? I've been hearing rumors.
They did, and we'll get into some of those too. Meals and entertainment is one of the things that they did away with, and
The 50%?
it's more for the extravagant stuff like big sports ticket items and stuff like that. You could still take meals and entertainment, but it can't be for the big sporting events or concerts or those type of things are considerable amount. But they did make some changes to
And the home office is still there, or no?
the home office deduction is still there.
Oh.
Yes, it is. So this was just another this was an example here of how it works. So in this example, we assume that there's $300,000 in profit as a realtor, right? And you file jointly. So I took this example from somewhere else, but say what you'd be able to do here in this example is you would deduct 20% of the profit, or $60,000. All right. So I think we pounded this out. We kind of went through an example already, but it's a deduction of taxes. It's not a tax credit. I'll kind of get that part. It will reduce your taxable income. Okay. It won't reduce your taxes dollar for dollar. So, but what I wanted to get here in this scenario is this $60,000 here, this deduction. If you fall into this 32% tax bracket, it would end up saving you about $19,000 in taxes in that scenario, right there. So this was just an example to show you the magnitude of this deduction. It's a pretty significant new deduction for taxes. Okay, so now we'll get into some things, some tax planning things that we can think about prior to year end that might be able to help out mitigate your tax liability. The first one being here is the vehicle mileage rate, and I'm sure you guys are all on top of that, keeping track of your miles. For 2013 or 18, I'm sorry, the mileage rate is 54.5 cents. It's unchanged from last year. The only caveat here is you have to keep track of your miles. Okay, it's not something that you can do at the end of the year where you said, "Oh, I drove 20% of the time, and I drove 10,000 miles. I get, I'm going to take, 2,000 mile tax deduction. I drove 10,000 miles." You got to do more than that. You actually have to keep track of your and document your mileage. There's some apps out there. One in particular that I have on here is an Everlance app. It's a free app. It does more than just keep track of your mileage. It also helps you keep track of your expenses and your receipts. So it might be something that you might want to take a look at. It has a GPS type of tracker in there, so once you take off, you can track your mileage automatically. Something to kind of keep on your mind there to try to help you, stay in compliance with that deduction.
At what point of income is that important for a starting realtor? At what?
I think it is at any point in time,
Uh-huh.
because, I mean, you know, if you have other income, if you have a loss in your first year, you could use these losses here from the mileage deduction to offset other income. So, as long as you have some other income to offset, maybe your husband or something like that, it's right away.
Okay.
Well, I was
Right
gonna
away.
say, like, I haven't earned anything, so, like, what?
Yeah, I mean, you know, in the first few years, you can, if you're doing this full time, and it's really what you do, you're putting the majority of your time into it, you can deduct it as an expense, even if you don't have any income. Right. Where it gets kind of difficult is if it's like a hobby, and there's a hobby loss rules where
How do
you
you-
can only
how do you
deduct
determine that?
your hobby losses.
Like,
You-
you know,
The
like,
time to spend it?
The time that you spend in it. I mean, if you're doing this, you know, if
Yeah,
this
like
is
an
the only
honor
thing that you
system.
do. I mean, if you're doing it on the
Sure.
side, if it's a side business and
Right.
you have a full-time job,
Uh.
it's going to be tough to say that this is not a hobby or something.
Right.
Like that on the side. If this
What-
is the only sole thing,
right.
and I have to come up with the hours. It's amount of hours. I think it's 1,500 hours. I want to say it's something like that, 1,500 hours, which is about 3/4 time,
Okay.
right? If you think a full year is 2,000 hours, I think it's 1,500 hours. But
What are the rules for, like, going to the office versus,
Yeah, I was just
you know,
saying
there's
that, and they're
commuting
like,
rules, commuting miles which don't count,
yeah,
versus like showing property obviously does count.
absolutely. If you have an office that you go to, where you go to every day, right? You have an office there, you work from there. You can't deduct the commuting miles. However, most of the individuals here that work for Equity Colorado, they probably work from home, right? And so that is considered their office. So coming here every day would be deductible. So driving back and forth here would not be considered a
Would you
commute.
have to claim a home office deduction in order to say your office is at home?
No, because you might not be eligible for the home office deduction. You may still have the home office at home.
Yeah.
So no, you wouldn't need to be. However, if you do have a job somewhere else, right, and you commute to work, you can't deduct your commute.
right.
But I think that everybody here, in this case, maybe Stacy and Todd, maybe they can't, or Paul, they can't deduct
Yeah.
driving here, but the rest of you could definitely take that deduction. Now, you know, there's, you know, what other ways? I mean, if you have an office here in the building or somewhere else, but I think everybody with equity would probably be able to deduct here unless they have another office here in the building or something like that. But in most cases, I think it's going to be deductible. That
What are you saying is gonna be deductible?
commuting from home to
To
here,
here?
to
Really?
here for you, yes,
Mm-hmm.
yes. Because I would think that you're
Your home office.
you're a home-based business, right?
Right.
You don't have an office anywhere. I mean, you don't do your work here. You come here for classes or meeting stuff to kind of enhance your
Right.
role as a realtor. So you could definitely deduct.
Well, when you go to
Okay.
take classes at other places as well, like.
Yes.
Anytime we
all
go.
that.
Yeah, anything
Okay.
for business, absolutely.
Okay.
Even if you got to go to the store for supplies,
Okay.
that would be another thing that you could do. You got to go to the store for some office supplies. That would be a way to do it. So, yeah, anything, if it's something to do with business, you can definitely deduct, other than maybe commuting, but that's not really considered business. That's a personal expense. So, the vehicle mileage rate is a really good thing. Where you can really save yourself a lot of tax dollars is with buying or leasing a vehicle. Okay, and the thing there is you have to really take advantage of this. You have to have used your vehicle for more than 50% for business. Okay, and it's for both new and used vehicles. But anyway, the new law here, they've actually increased the depreciation or the bonus depreciation for vehicles, whereas in the first year of buying a vehicle, either new or used, in the first year, you can deduct up to $18,000 in the first year, depending on how expensive the car was. If it wasn't more than $18,000, you couldn't deduct $18,000. But you know, if it's a $20,000 car, say, you know, you could deduct up to almost the full amount in the first year.
Wow.
So that definitely could be a big write-off for you. And then and then there's some other limits in follow-on years. If you don't use your vehicle for 100%, oh, I'm sorry, go ahead, Nancy.
Well, no, finish what you're,
Yeah, if you don't use your car for 100% for business, then what you have to do is you have to prorate the expenses. So, say for instance, you use your car 50/50, you're only able to deduct 50% of any costs that are associated. So if you do 50%, you'd only get to take, half of that as depreciation, and so on and so forth for all of your expenses.
How would
So-
you determine the use?
And it would be on
mileage?
miles, yeah, that would be on miles. So, if you have more than one vehicle, it's very easy to stay within 100%, right? If you have more than one vehicle. If you only have one vehicle, it's going to be pretty difficult to explain to the IRS how you got around, without another vehicle, right? So the key here is if you want to do one for 100%, key here is have two vehicles, right? Maybe your husband has a vehicle that you might use for personal purposes. My vehicle, I use 100% for business. That's all I use it for. You have to have two vehicles for that, I would say. Otherwise, you might get scrutinized by the IRS on that one, I would think.
If you use.
Unless
if
you have a bike or
say-
something. Unless you have a bike or a moped or something like that, I guess. But
Realtors talk about real estate everywhere. We have no personal life.
yeah,
Oh, you do?
exactly.
I'm just
Right.
saying.
And
when
if
you
I
go to
do,
church, you
I
talk
drive
about
my
real
husband's
estate.
car.
You do, yeah.
So it's business.
It's business.
Yeah. And my husband drives me around all the time, right? For personal, right?
Yeah.
You only drive when it's for business.
Correct.
Right. So, you just have to have another vehicle for you to even rationalize.
Just say that. I mean, like, even though we may not use.
Well, I can't tell you to say that, but it would be
I mean-
difficult to explain to the IRS that you have one car.
Oh,
Yeah.
right.
Right,
Right.
you're using it
Yeah,
only
so
for
100%
business.
For business.
Now, how much you use it for business or not, that's up to you, but I'm just saying, to get to 100%, you'd have to have another vehicle, I would
When
say.
they look at your log though, on the 100% car.
Your
and
mileage
if
better
it's-
equal.
Yeah,
your
it better
mileage.
equal what if you've gone from,
Yeah.
50,000 to 70,000 for the year or something. Those need to be
Yeah.
all business miles. If that car is
Yeah.
100%, and the log needs to show that you've gone from 50 to 70 with business.
Or I don't use my vehicle for personal, I use it for business. That's all I use it for, so it's all business miles.
Clearly,
Yeah.
you're not doing groceries or picking up.
Well, that's
Yeah,
what
yeah.
I was saying.
your
Like, you know,
kids.
But you'd have to have another vehicle. This
Yes.
is
Yeah.
just being a little creative here,
Yeah.
right? I'm not telling you to
Okay.
do anything wrong or anything, but
Sure.
it's
What do they
just
look
being more
for? Like
creative.
if you were audited, what is going to be on that log that they're going to look for 100% mileage
I mean,
on a car that you occasionally take your kids
I mean,
to
it-
this,
I mean,
that, and the other.
right.
And your
Now,
mileage
I
is
don't know too
gonna
many
have to
people that
match.
only 100% use, this car never gets used except for business. I don't take it to the
yeah, so then you would have
grocery
to, if you use it for personal purposes, you need to log them,
Yeah.
yes.
Yeah.
If you use it for 100% business,
But I was gonna say, like,
then you
don't
use it
have
for
to do,
100%
like,
business,
yeah,
but,
homes,
if you don't, then you would have to keep a log,
I can
yeah,
do it. I'll take 75%.
definitely.
Yeah.
So
So-
the 100% is only for heavy SUVs and like.
Now this is another thing, so this is a different one. The last one there that you see, 100% first year bonus depreciation, you can actually, in the tax law, you can actually deduct 100% of the vehicle if it weighs more than 6,000 or more pounds. So it'd
Really?
have to be a heavy, SUV or pickup, but yes, you could.
And then
Now, you'd have to have the
mileage
income.
doesn't need to match?
No,
Because
now
you
this
have
is a
your car?
different scenario. This is depreciation. Is what we're talking here.
Oh, I'm sorry, I was up above it.
This is depreciation that we're talking here. So,
Do you have to use
100%.
actual for that and not mileage?
this is a different one. So this is just for the depreciation portion of it, not the actual. All I'm saying, this is a different depreciation. This is a bonus depreciation up here. This is what's called a Section 179 deduction right here. So if your vehicle weighs more than 6,000 pounds and it's like a heavy SUV pickup or van, you can deduct 100% of the purchase price of that vehicle in the first year, and you don't have to depreciate it over 4 or 5 years.
I
Right?
guess I'm just saying-
That's what I'm talking about here now. I don't want to get the 100% confused and stuff here. This is for deducting, the business. If you use it less than 100%, then you have to kind of prorate it. 80%. If say you drove it 80% for business, 20% for personal, you'd only get to take 80% of the expenses. The other 20% would be.
But I'm saying, if you take a standard mileage deduction, do you also depreciate?
Oh, no. You take one or the other.
Actual,
You
yeah,
take
okay.
one or the other.
That's what I
That was
meant,
gonna be
yeah.
my question, it is either or,
Yeah,
you either
either or.
take the mileage or take the
Right.
depreciation,
Right.
right?
That's right.
Okay.
That's
So
correct.
it used to be that the mileage was usually the better deal, but maybe now with this bonus,
It could be.
You can't
It could
switch
be
though,
still,
can
but this is more when you're buying a new vehicle, and you're getting the depreciation up front, where it definitely makes sense, to maybe do this, especially if it's a bigger vehicle, right? I mean, you'd have to drive if you were like $40,000 vehicle. I mean, in order to get the same amount of deduction, this would be 100%. You get to take a $40,000 deduction if it's a bigger vehicle this year. If you bought it this year,
The whole
Okay.
price of the car?
yeah, that's what I'm saying. The whole price of the car. It's a-
100%.
100% first year bonus depreciation.
So
So
my next-
if you bought a Cadillac
buying a
Escalade,
Right.
you bought a Cadillac
Yeah.
Escalade, and I believe those are more than 6,000 pounds. Cost $60,000. You would able to do a bonus depreciation. Now your income would have to support it. You'd have to have the income there for it, but you could deduct the entire purchase price of that vehicle in 2018
And
if
do
you bought it
need-
this year.
Do you need to have purchased that vehicle, using that example, at a certain point in the year? Or could you-
Prior to the end of the year, yes.
Just prior to the
Yeah.
end of the year?
Prior to the
You have
end
to
of
buy
the
the car prior to the end?
Yes.
There's still time, Nancy.
There's still time.
Yeah, wasn't, yeah. Probably, yeah, fascinating.
Yeah.
But not that last item, but the other examples, it's an either or, you either take mileage or
Yes.
depreciation.
Yeah, so it's
depending
either
on-
or between these two.
Depending on
So
which one.
for this example, 40,000, we'll go with it, 40,000, you'd have to drive like 80,000 miles to get that same deduction here, So in that
So-
case, definitely it makes sense to do here. And then even if it's smaller car, less than 6,000 pounds, I mean, still 18,000 in the first year, that's a big deduction. It would take you about 36,000 miles just to be able to equal the depreciation, and that doesn't include, when you buy or lease a car, you can also deduct the insurance, your auto insurance, your gas, maintenance, everything that it takes to maintain that vehicle. You can deduct it here versus mileage, it's just on a per
So let me
mile type
ask
of
you-
basis.
If you finished using a car in 2017, bought a new car in 2018, but in 2017 you took the standard for the new car in 2008, because they want consistency, right? They don't want you going back and forth
No,
from
you can go
standard
back
to
and forth.
actual. Oh, you can? Good.
From year to year.
Yeah, you can. So it's a big it's a big deduction, and I think there's a lot of realtors that take advantage of this, especially if it's something that you're, I wouldn't advise you if you don't have the money to go out and buy a brand new vehicle just to save on taxes. Right? But if you're looking for a new vehicle, if you're looking for a new vehicle or something, you probably want to think about this stuff here, and you probably want to do it prior to the end of the year versus after to take advantage of it, especially if you have, you've had a great year or something, you want to reduce your tax hit. This would be a great tool to be able to do that. So
So for the year one, the 10 and the 18, I'm a little bit confused on that. So it's 10 grand for year one or 18 if you claim.
yeah, this is
first-
the standard. This is the standard depreciation right here.
So it goes
But
from 10
if you
to
do
6.
bonus, you can increase it by another 18,000 or 8,000. I'm sorry, so you get a extra $8,000, so 18,000 in the first year. These are the max amounts. Okay. So this is for vehicles less than 6,000 pounds. This one here, you get to deduct 100% of the depreciation in year one for anything over 6,000 pounds, or the bigger SUVs. So
the depreciation reduces you. So if you took that 18,000 and you made 30,000, you have $12,000
income left, right? Yeah. Yeah,
I've been
business
doing that
income.
wrong. Yeah.
Yeah, I mean, if you're buying new cars, yeah, I mean, you should be taking advantage of this. I mean, it could be, yeah, it's a big deal. I mean, it's one of the reasons why I bought a brand new vehicle a few years ago. I was always a used car person, and you don't have to buy a new one for this, but I bought a certain vehicle where I wanted to try to maximize as much as I could the deduction I needed a tax write-off. So it can definitely help. I mean, you think about that right there. If you're able to write that off, that's if a bigger vehicle, right? $40,000, you're in the 30% tax bracket right there. I mean, that's 12 grand. I mean, that's a big,
And it just has to be used over 50% for business.
Yes, just has to be used more than 50% business.
Well-
But you wouldn't be able to depreciate it all if you used it, say 50% or more. Say it was 51%.
Yeah.
You'd only get to take 51% of the vehicle purchase price.
You can only take,
What
What you're
the
using
proportion that you use.
for business, yes.
and what if you only buy it at the end of the year?
Oh, that doesn't matter.
Well, you will only-
at the end of the year, geez, that would be easy to use it all for business, right?
Right.
Yeah. So you could just ride it around for business for the first, day. 100% for business. Buy it on December 31st, right?
And then
Yeah.
you say
And you drive
use
it around
all-
just for business. That you make it a point, just for business.
Can you do that every year?
Well, I mean, on that bonus depreciation, I mean, you wouldn't have to because it'd all be depreciated that 1 year.
Oh, it's interesting.
So in addition to the depreciation, you can claim gas and other expenses
Yes.
too, but you won't be able to use the mileage
Right.
log.
It's one or the other. That's correct.
But if you use the mileage log, you wouldn't be able to depreciate the car.
If you have to. It's either or, one or the other. It's not both. You can't do both. Yeah. Now, understand with the expenses and stuff, you have to take the same. If you're not using the vehicle 100%, you have to take the same percentage your gas and stuff as you do for the depreciation.
60% for all of it.
Yeah, that's right. That's correct. So, yeah, I thought you guys would be interested in this one here.
Yes.
We can talk about this more if you want to later on. If you want to talk after or whatever on specifics, but it's a great planning tool for you guys. I know. That's why I had them here on the top too. Some of the other top 25 deductions, I heard it earlier, the home office deduction. It's definitely a good one, I don't know how to best explain this to you, but what you're able to do with the home office deduction is to write off the expenses for the entire home based on the percentage of your home office to your home based on square footage. So for instance, if you had a 1,000 square foot home, 200 square foot office, you would be able to deduct 20% of all your home expenses, that being interest on your mortgage, take 20% of that. You could also take 20% of your insurance costs, 20% of your utilities, 20% of your landscaping costs, even landscaping, cleaning. If you have somebody clean your house, you take 20% of that. So it actually could be a pretty good size deduction. The one thing here though is you have to have income for the home office deduction. You can't offset. It can't create a loss for you. So you can only deduct it up to the amount of income that you make. Another thing too here is S corporations. The home office deduction does not apply to S corporations, but there are kind of ways around that where you can set up a sole proprietor to maybe transfer some income from your business to maybe a Schedule C or a sole proprietorship that you might have, and take the home office deduction on a Schedule C, even though you still have a business that's an S Corp. So there's some ways around doing that, but that's a good deduction. There's also another way where you can streamline it and just kind of take a pro rata, or it's called the what is it? It's not at the top of my head, I can't think of it right now. But it's a streamlined basis. It's just based on the square footage of your house and the square footage of your home office, and you get a standard kind of like deduction based on that, the proportionate share of your home. So if you've always thought that this is really complicated to do the home office deduction, I don't want to go through that. There is a way for your accountant to calculate a kind of a standard deduction for that based on just square footage of your home and office. Okay, it's called the simplified approach. That's what it is, the simplified home office deduction.
And that would include all these other expenses.
It's kind of it takes an average, I guess. It's a standard. It doesn't take into account your expenses. It's kind of something that the government gives you like a standard deduction for it. It's a simplified method, is what they call it, where you can still deduct the home office deduction. It may not be more than what you could do if you itemized everything and stuff, but if you don't want to go through the hassle and you thought it was too much of a hassle, you still can do it on a simplified method, and all it would take is your home square footage calculation here for that. Other deductions here, any real estate software that you buy, any software apps that you use for your real estate business are deductible. Cell phones, tablets, anything that you purchase. If you go out and purchase a phone, that's deductible. Office supplies, assistants, if you use those, that's probably a no-brainer there. Bookkeepers, office rent, your office equipment and supplies, internet. If you're using internet at home, I have a lot of people that will deduct 100% of that because they probably wouldn't even have internet if they didn't have a business, right? There's ways to rationalize that. Your phone plan costs, marketing, signage, any conventions or anything where you go to educate yourself. If you travel somewhere for a convention, you can take all the travel expenses for that. If you do vacation on that, there's some things that you could probably still make some of it deductible, but you want to try to keep your whenever you're traveling for those, you want to make sure you're doing more business than vacationing on that. It's got to be more than 50% for you to be able to deduct your travel costs. And when I say travel costs, I mean going back and forth, your flights or whatnot. If you're there for more than 50% of the time, you can deduct those travel costs. So something to think about. Your transportation fees, Uber fees, those are deductible if you're doing something for business. And then client meals, those are still deductible. We did hear the question about entertainment. Those have been limited now, where it's those extravagant purchases, sporting events, concert tickets, that were previously deductible as an entertainment expense are no longer deductible. And if you want a longer list of those, I can get you a list of what those are. It's a long laundry list.
Is there a limit on the meals and entertainment? I mean, let's say you take, clients to dinner or something. Is there a limit on it? How much you can
No, there's no limit.
I think for the gift there is, right?
Yeah, for gifts there are. It's a ridiculous low amount,
It is.
$25, but
It's ridiculous.
you can definitely get to take a 50% deduction on those type of meals. So yeah, there's no limit on that.
On the assistant.
Oh, sorry.
Do you have to claim them as an employee, or how do you deal?
No, they can be a contractor as well. I mean, as long as you're paying them and there's an expense there and they're doing work for you for your business, you can deduct.
So we wouldn't have to file a 1099 for them, or you just get.
I mean, you may or may not have to. It just depends on how much control you have over their work. If they're using your computer equipment and you designate their hours when they can come and when they go, then they do need to be an employee.
So
okay?
if we don't.
But if they're kind of doing the job on their own and they're doing it on their own time, they use their own computer, then they can be considered an independent contractor. What you want to just do there is you would want to have a contract agreement, consulting agreement, contractor agreement in place for that. That stipulates that they're using their own equipment. They're working on their own time. Kind of define, you know, what an independent contractor is and put that in their agreement, right?
But other than that,
But then other than that, you wouldn't have to withhold taxes. You would have, if you paid them more than $600, you'd have to issue them a 1099 at the end of the year.
So under $600,
There's none. There, you wouldn't have to issue a 1099. That's
so we can use that for transaction coordination. When we pay someone to put the deal together, deadlines and forms and all that.
yeah. I
That
mean,
works for that.
yeah. I mean, it does. I mean, do somebody to do your paperwork, right? Is that what you're
Yeah,
saying?
yeah.
Yeah.
But if they have their own business, you don't have to issue them a 1099, right? You're just.
Well, certain types of businesses, like corporations, you don't have to issue a 1099 to. You still can. You don't have to. There's just, you know, corporations, they're exempt from being required for you to.
If they
Issue a
if they
1099.
provide an invoice, let's say per transaction, that is your documentation for a business expense.
That's a good one, yes.
And it would in there, I mean, no.
That would be, and if they're not issuing invoices, I mean, then, you know, you'd have your bank records, clear checks, that type of stuff.
so we don't need the invoice.
You don't
necessarily.
necessarily need an invoice, you don't, but you just need to have record of it. You do have to have record of it somehow, a bank record or, yeah, most issue an invoice. They should, right?
Yeah, but let's say we have a stager coming in and they just do like a few hours of work and do it. We just give them some money. They wouldn't have necessarily a company to issue us an invoice. So
And you give them cash
no, we
or give them a check?
check. Yeah.
Then that check
It's
would
fine.
be good.
Okay.
Check would be fine.
Any caution for any like adult kids to do like bookkeeping, and I mean not bookkeeping, filing and just I have my older daughter do. I might have filing, I might have her enter expenses.
You know, that's a great thing. That's a great thing to do, is to be able to hire your kids, and you can pay them up to. It used to be their standard deduction. I think it's like $6,000 with it being exempt, that they don't have to claim it on their taxes, and you can deduct it. So hiring your kids is a good way to help, reduce your tax liability. Yes, that's a good one. I think there is a limit on it, but I think it's a pretty high limit. It's like 6,000 or less. But yeah, that's a good one, and you can do that. Definitely, you can do
How
that.
old do they have to be?
I mean, they could be, they could be any age. I mean, there's child labor laws, right? So you can't.
Your 5-year-old.
Filing.
I don't know. You might look at that child labor. Yeah. No slave labor though. But yes, your older kids that are eligible to work and stuff, they can. You pay your kid help you do some paperwork or something like that. Yeah, small amounts probably wouldn't hurt anything. So there's some more here. Client gifts is one of those, which we talked about a little bit ago. Them being limited, they are limited. It's ridiculous, the amount. And what I tell a lot of people is some of those gifts that you buy, you may want to just stick them in a different category, right? In marketing. Put them in marketing or something like that. It's just, and I've never seen anybody be audited for gifts. So I mean, the likelihood if you paid more than $25 for a gift, for you that gift being challenged in an IRS audit is probably like almost nothing. Okay. They would have to be auditing you for something else for them to even to look at that. But client gifts, those are deductions. The retirement plan contributions. I don't know if any of you have a retirement plan within your business. There's some great things there, especially if you're paying yourself a wage. Like a SEP IRA is a great tool if you want to be able to put away more into retirement than you could into versus like an individual IRA. Yes, Nancy.
And what is the cutoff for funding, say, SEP?
Yeah, that's
2018.
so for SEP, it's the maximum amount that you can contribute, I believe, is around $52,000. However, it's limited based on your wages that you earn. So it's limited to 25% of your wages. So you'd actually have to be earning some wages, like, or paying yourself a check where you're withholding taxes. In that case, to reach that limit, you'd have to pay yourself like a couple $100,000 to get to 50. But even if you're paying yourself $50,000, you could contribute to a SEP. In that scenario, you could contribute up to $12,500, which would be more than your individual IRA limits, which are about $5,500. So they are good tools.
And
You just have to make sure that you're paying yourself a wage as well to
Even
be
for a sole
eligible.
proprietor?
Sole proprietors
You don't have to pay yourself a wage for that.
there isn't not for sole proprietors
Oh,
there.
yeah,
You'd
yes.
have to use
Okay.
you'd have to have a S corporation or a corporation something.
And the calendar cutoff for funding it to have it included in, say, the 2018 would be by.
It's the tax deadline.
It's the tax deadline?
Yes. So it'd be April 15th. It's a great way to postpone paying your taxes for sure. Retirement claim contributions. I don't think you guys have any desk fees here. Nobody has any desks here. But if you did, if you're a realtor and you had a desk somewhere where you had a real estate firm where you had to, pay for a desk fee. There are some other fees though that I know that Equity Colorado charges. It's on a per transaction basis. There's a monthly fee, right? I think it's $50 or something like.
So
60 now. It's going to 59, $60. Those are deductible. Any education that you need to pay for that is to help you with your business, right? Those are deductibles.
So this is only if you have an income, is that correct?
No, I mean if you're doing this,
Like we just started, so we may not have anything by the end of the year, but like our continuing education, our schools,
Yes.
our
yes, you'd be able to go.
license fees. That's what I'm saying. All that stuff is
That stuff would create loss. This stuff here would create losses for you. The only one that wouldn't is that home office deduction. If you don't have any income, you couldn't use the home office deduction. You have to have income to offset. These other ones, though, you could go into a loss, and it could help offset income from other sources.
Well, I was
Maybe
gonna say
your-
like my husband.
Yes, your
So
husband.
he's
That's
our-
right.
but
It would help offset his income. So yes,
I'm definitely gonna give you my email.
okay, not a problem. Your dues and membership fees. Any dues for like Smedra. Those are these fees here. Any dues or fees that are related to your business, you could deduct those. Your insurance, maybe you have some errors and omissions insurance, that type liability insurance. Those are all deductible.
It's deducted in your monthly,
Oh,
so if you deduct your monthly 59, that includes your errors and omissions.
oh,
Right,
Is
but
that
I'm saying,
itemized?
would it be included
it's not
in
separate.
It's only.
It's just,
It's in the
not-
59.
It's in the
Right,
59.
yeah, right.
So you get
Yeah.
definitely get to take that one.
Okay, well, I was
Definitely.
like, you can take it as a package or,
Yeah. Any professional services that you use, if you use an
Okay.
accountant, those are deductible.
right, and separate.
Legal fees for setting up your business, or ongoing legal costs, those are deductible. Interest on business loans or business credit cards, right? Even even interest on that home equity loan that you're paying for your business would be, you could put in here as interest. I consider that a business loan. You could loan money to yourself, right? You could just set up a note from your business to you, and you got access to those funds from your home equity line. This is where it would show up as interest on business loans. Any franchise fees, that doesn't really pertain to you guys. If you guys had a franchise, real estate franchise, that would be deductible as well. You don't see those here. And then finally, wages or any benefits that you pay for you or your employees would be deductible. So a lot of different deductions there that there's plenty more than those. If there's a question that you have, on a certain type of expense, is this deductible? Just shoot me an email or something, and I'd be happy to answer any questions that you have if there's one that I didn't talk about. And then here's these are just some year-end tax planning tips that you can think about prior to the end of the year to try to help reduce your tax liability. One is, deferring income, or maybe, and also using that, if you're going to defer income, maybe you want to accelerate your expenses as well. Maybe I'll throw that in there too. You want to defer income. And when I say defer income, maybe you can postpone a closing till January 1st. I don't know, instead of December 31st. That would be a way to defer some income. If you're a cash basis taxpayer and you received a check for your commissions, you might want to wait until after the first of the year to deposit that check, right? So that you could claim that income in the following year. On the other hand, if you have some expenses that you might, that are coming up, and you might want to think about maybe paying those sooner rather than later, because if you pay those this year versus next year, and you're a cash basis taxpayer, and when I say cash basis, it's either cash or accrual. You kind of have to elect what you are as far as a taxpayer when you first start your business. But a cash basis taxpayer is when you spend or receive the money, is when it's either recognized or incurred, the expenses. So if you're a cash basis taxpayer, which most C Corp, Schedule C taxpayers or sole proprietors are, you just want to make sure that if you have some expenses, maybe you want to accelerate those, pay for those up front. Maybe some insurance, maybe you want to prepay for next year's insurance before the end of the year. Maybe it's paying a contractor. You've got a few bills, let's make sure that those guys get paid prior to the end of the year and still next year. Maybe you have them cut you an invoice prior to year end so you can get those done this year. So those are some things that you can do. We talked about, an IRA. You can maybe open up an IRA, a SEP IRA, prior to the end of the year if you're set up properly, or maybe it's an individual IRA. You want to add to that. You do have some time between now and the end of the year. After that, with IRAs, you can contribute those up to the tax deadline, which would be, I believe it's April 15th next year. Other thing, you might want to contribute to some charities prior to the end of the year. These are all things here, that you can do prior to the end of the year that you can't do after. Once January 1st rolls around, you can't be kind of thinking of these things anymore, other than the IRA contribution, but your charities. You might want to pay some college costs. Maybe you have a student, one of your children are in college. Maybe you want to prepay some of their tuition prior to the end of the year. Something that you can do. Bunching your deductible expenses. That's one there where maybe you want to, you give to quite a bit to charities, right? And you want to try to get over that 24,000 standard deduction. Maybe instead of giving 10,000 per year, maybe you give 20,000 this year and none next year. So you're kind of flip-flopping between maybe the standard deduction and the itemized deduction to try to maximize, your charitable contributions, right? Maybe it's, we talked about that earlier. Your expenses, maybe you want to bunch them all at the end of the year instead of next year. It's things that you might want to try to do to, kind of offset income this year, and it could make effect next year, but at least you're thinking about it and trying to maximize things. So. Harvesting tax losses, that would be one where, say for instance, you have some investments in some stock. Maybe you have some income in other places or some other capital gains. Maybe you have a stock that's losing, it's lost a lot of value. Maybe you want to sell those prior to year end to capture those capital losses to offset some of your capital gains from other sources. That might be something that you could do to harvest some tax losses this year. And then, make the most of your home. There it's the home office deduction. It's the interest on your house. Maybe making a payment, maybe making your mortgage payment. Instead of doing it at the first of the month, maybe in December do it on the last day that you could do it, last business day in December instead of waiting. That could save you a few dollars there, capturing that interest in this year. with that scenario, you probably want to do that every single year, because if you don't, then the next year you would have that much less of an interest deduction. So something to think about with your mortgage. You could prepay your real estate taxes. If you're below that $10,000, you might want to think about prepaying your real estate taxes. And then if you want to calculate your taxes and you want to do it on your own, there's a website here that you can go to. It's at taxact.com. If you go and put in Tax Act and then like 2008 tax calculator, if you do that, if you put that into the Google and check that out, this should be the top one that comes up in the top of your list there. And it's a pretty straightforward one where it just takes your earnings from wages, your earnings from your business, how many dependents that you have. It doesn't go into a lot of detail, but it's a good place to start, right? It's a good place to start. If you guys are having, if you go here and you see a big tax liability and you're like, uh-oh, maybe you need some help, I'd be happy to, talk to you over the phone. There'd be no obligation or anything like that, just for some advice for any of you. If you want to just give me a call, I pass around my card, or if you need some advice or maybe just something doesn't seem right, I'd be happy to talk to you about it. With that, I just want to say here, that with all this, this is all about, there's two types of things. There's tax avoidance and there's tax evasion. What I'm talking about here is things that they help you, avoid taxes, not go to prison, right? I just want to make that point clear. Anything here, that we talked about today is on the up and up, and we're trying to, look for loopholes in any legal loopholes that we can in the IRS code to help you avoid paying taxes this year, and not trying to evade anything. But with that, if you guys have any other questions, I can open up for questions now.
You first mentioned when we started that you're a cloud-based service. Could you explain that?
Yeah, absolutely. So the solutions that we use are when I say cloud, they reside on the internet.
Mm-hmm.
So we use solutions like QuickBooks Online. We use a bill pay software called Bill.com. All of our when we send tax documents and stuff, we use the cloud where we use a secure environment in the cloud where, say for instance, I send you a document, I don't attach it to my email. I actually have a link where you can download it from the cloud. When I say cloud, it's internet based.
Gotcha.
So we're an internet based accounting firm. So we can help our clients from anywhere. I was talking to Todd earlier, at one point in time he used QuickBooks, the desktop version, and he switched to QuickBooks Online, which is on the cloud. And it just changes the way you do business, because you don't need to be sitting in front of your desk to look at your books. You can be in Hawaii on vacation and be able to pull up your accounting software or pay your bills or whatnot. So we're when I say that, I just probably want to get across, we're a forward-thinking firm where we believe in technology and we believe in planning ahead of time as far as taxes are concerned, and anything else. That's kind of how we work with our clients, is on the cloud and in a secure environment. So good question. It's a good one.
So if I were going to go from a sole proprietor to C Corp,
Or an S Corp,
is it S Corp or C Corp? Which
It's
one
an
is
S
the one where
corporation.
you pay yourself a wage?
So I should have talked about this today. I kind of pondered it a little bit, the S Corp, and I'll talk about it now. So when you're a sole proprietor, the income that you generate from your business is subject to self-employment tax. It's a big, hefty tax. What self-employment tax is, it's Social Security and Medicare for the self-employed.
Yeah, I just paid it.
15.3% tax. It's a 15.3% tax, and what a lot of business owners do to try to mitigate that is they set up an S corporation. S corporations are exempt from paying self-employment tax. However, the IRS has said that you have to pay yourself in that scenario, you have to pay yourself a reasonable wage. When you pay yourself a wage, you pay Social Security and Medicare. So that's kind of like they're
Only
forcing
on
you
that wage,
only on that wage.
not on the total.
Right. And so when I talk to my clients, there's a couple different ways that you can look at it. It's either like maybe 40-50% of your net income that you pay yourself in a wage, or you go out there and you look, try to find other realtors or other people in your line of work to see what they're paid, and you kind of pick what's less. Normally it's like the 40-50%. In that scenario, let's say you make $100,000 net, right? Net income in your business. A sole proprietor would pay like $15,300 in self-employment tax. A person with an S corporation, they would have the same amount of net income before they paid themselves, right? Then they have to pay themselves the wage. It's 40-50%, we'll say 50% to keep it easy. 50% of those wages would be, you'd have to pay Social Security and Medicare tax on. The other 50% would be exempt from self-employment taxes. In that case, if you would have set up an S corporation and done all that, in that case it would have saved you about $7,500 in self-employment taxes in that scenario.
Because you're not paying on the total, you're only paying on the salary.
Yeah. You're paying on the so both a self-employed sole proprietor makes $100,000. The S corp makes $100,000, right? They both make the same amount. But with an S corp, you're required, same compliance, you're required to pay yourself a reasonable wage, $50,000. So it reduces your net income down to like $50,000.
Right.
The 100 over here, you're paying all self-employment tax on all of it. On
Right.
this one over here, S corps aren't subject or exempt from self-employment tax, so they only have to pay, Social Security and Medicare on the wages that they make. So you're saving self-employment tax on $50,000 or $7,500.
Right.
$7,500
Can
bucks.
you
A little
just
more
say
than that.
like dividends or something, or?
Other than that, so for everything that's not a wage, what you would be is it'd be an owner draw or distribution, which they're not a deduction or a dividend per se. It's just a distribution of earnings. So you only pay tax on the earnings anyway. Once you have earnings in your business, then you can distribute those as distributions, and they're not taxed separately. There's
All
like
the
a
other
secret.
expenses.
So you guys set all of that up from the beginning then? Like,
Yeah, I mean,
incorporating
so that
all
I was
that
getting
stuff?
to that. That's a good point. That's a good point that you bring up. So there are some costs associated with setting up an S corporation, and there's one it's a separate business entity, so you have to prepare a separate tax return. It's called an 1120S, and you can expect to pay about $500 to $600 to have that done, and then you have to pay yourself a wage, and so there's some costs associated with doing a payroll, filing those returns. That's another about $600. So all in all, to do that, and then to set up the business would be another, like say $300-400 to set up the business. So you're talking about an extra like $1,500. What I tell my clients is really to make it worth your time and while, you probably want to have about $20,000 of net income to offset those costs, to have the tax benefit to offset those costs. That's kind of the break-even point. So yes, there are some things that you got to do up front. Do you do them all up front? It kind of depends on how much income you're generating from your business. If you're generating more than $20,000 of net income on an annual basis, it's probably a good time to think about setting up an S corporation. Absolutely.
Can you do it closer to the end of the year once you know how much you've made?
If you have an LLC already set up,
and that was another question.
If you have an LLC already set up, there's a way that we can elect to be treated an S corporation for the entire year. We'd have to do that on your tax return. If you don't, it'd be pretty difficult, right? It'd be difficult to explain to the IRS, I ran as an S corporation all year, but I only set it up right at the end of the year. If you have an LLC that you started at the beginning of the year, I can convert that LLC to an S corporation.
Why set up an LLC?
Just because they're less. There's less administrative work to kind of keep it in compliance with the Secretary of State and the state law. When you set up a corporation, you have you know, you have to have minutes, you have to have board of directors, there's just, you have to issue stock, you know, and it's a lot less cumbersome with an LLC. So, and you get the same limited liability protection. So I advise my clients normally start off with an LLC, and then you're still treated as an LLC for state purposes, but you can actually request from the IRS to be treated as an S corporation just for tax.
Toward the end of the year once.
And you could do that. It could even be next year when we file the taxes, but in order to get benefit of an S corporation for the entire year, you have to at least have an LLC in place for me to convert, something for me to convert to an S corp.
So if you have set up an LLC, you can by the end of the year convert it, depending on the numbers, convert it to S Corp for the whole
For as long as you've been in LLC,
LLC.
yes.
Okay. And how would you handle the part of the year which in which you had not the LLC?
If you didn't,
That
you'd
would
have
Schedule C.
you have to have a cutoff date, and for everything prior to that cutoff date, you'd have to be recognized as recognized or treated as a sole proprietor, which would be subject to self-employment tax, and then everything after that would be.
So the thing is, we here get a 1099 for the whole whatever commission we get, and
Yeah.
it's not like, I don't know, it doesn't
That's
have to
okay.
be like,
I know what you're getting at. So you get a 1099, it's to you personally.
yes.
There's ways around that where I could flush that through your Schedule C and move it to your S corp through just through an entry, right?
Okay.
And
think
so
they
we
can
would
change
we would
your-
recognize the income,
I didn't know.
and they can change it prior to the year end. You might be able to talk to them and
Okay.
fill out another
So the
W-9.
commission
Yeah, I
check
didn't know
goes
that.
to your business instead of your
I think
name.
so.
But even if you haven't, I mean, even if you haven't done that, if you have an S corp in place, right, I could still move that income from a Schedule C by, you know, recognizing the income and then having an expense that transfers the money to your.
And
To
you
your
guys
S corp.
can do it all, from setting up the LLC to the
Going to the-
payroll to
Absolutely.
everything.
Absolutely.
Okay.
Everything from setting up the business in
An
the state, getting the EIN number, getting it, getting an EIN number, setting up an operating agreement. We do, you know, operating agreements are legal documents that you have to set up to separate you from the business. That kind of creates the limited liability. I can do single member businesses. I don't do multi-members because it's more of a, you know, you won't sue yourself, you know, but you have to have an operating agreement in place to have
I'd like to.
a business sometimes.
Yeah.
So, but yeah, I'll do an operating agreement, you know, set you up in all your local jurisdictions. If you're, depending on what cities you are in, you might need a business license, setting up the state accounts for, you know, withholding and your unemployment. So yes, we absolutely do all that,
Does
as
it
well as the
cost-
tax returns.
Sorry, does it cost the same to set up an LLC as it does an S corp?
You know,
You're
there's a
$1,500.
break that I give for setting up an LLC, and it's so I charge. What I do is I charge $395 for setting up an S corporation, and that doesn't include, like, there's a $50 fee with the Secretary of State that we charge as well. Any costs plus any costs that we incur. That there. If you just want to set up an LLC, I reduce it by $75, and so whenever you're ready, so it would be $325
Plus costs.
plus cost. But if you want to do an S corp down the road, and whenever you're ready, I would just charge you $75 to convert it to an S corporation.
Why would you want one or the other?
Well, you know, the LLC is going to help you for legal purposes, help create that limited liability.
It protects
You know,
us,
it protects
right?
your assets, your personal assets, from things that might happen in your business, right? You may get sued or whatever. I know you have errors and omissions, but it's a good thing, you know, for peace of mind.
I mean, I
The
hear
other
of
thing-
realtors being S corp though.
Yeah.
As opposed to LLCs, so.
But here's the thing with that LLC, you can be designated or considered an S corporation, but you have to make that election with the IRS. You have to send in a form, and it's pretty straight. It's a pretty straightforward thing.
When you pay your taxes for the previous year or at the time of that you.
Yeah, I mean, you can
start-
actually do it. You can do it when you're preparing taxes. You could, but you would want a professional to do it because it would be, you'd have to do it the right way. You'd have to set up a separate tax return, and you'd have to do that, make that election with that tax return, and state a reason why it wasn't done. You know, maybe there's different reasons that you may come up with. I thought my accountant was going to set it up my prior accountant was gonna set it up or whatnot, or I just didn't realize, I thought I was an S corporation, whatever the case may be, but you can do that when you're preparing your taxes for next year. If you have an LLC in place, you have to have an LLC in place.
So if
So-
you have an LLC, why would you want to switch to an S?
So, good, so then that would be, so then why would you wanna switch it to try to mitigate the self-employment tax? It's
Right.
really, that is the thing.
Okay,
that
so,
15
but I thought you
point-
could do for taxes, you could be an LLC and for tax purposes, be considered an
And you
S corp.
can, that's right.
So why would you wanna switch if you get the best of both worlds?
Oh,
be an
but
LLC?
you're either, for tax, and this is all for tax purposes, is what I'm talking, not legal purposes. So, you're either an S corp or you're not for tax purposes, doesn't matter what type of entity you are. If you're not, if you're an LLC, you're gonna be paying self-employment tax on every dime you earn.
Right, cause
Whereas-
sole proprietor.
Yeah, sole
Right.
proprietor.
Right.
Yeah.
For-
So the reason why
can't be, when you say I'm treated as you'd be treated as an S corp.
you
for
wouldn't
tax
file any
purposes.
more Schedule C or anything like that, you would just file a separate tax return.
Right,
Which that income then wouldn't be subject to self-employment tax. There
right,
wouldn't
if
be.
you're considered. So why would you, when you say you're considered, that means you've switched over then, or
Ye-
no?
Yes,
Okay,
yes it does.
okay, I thought you
I'm
could still
sorry.
say an LLC and be considered
No.
without
I mean,
switching.
I don't wanna confuse you much, I mean, for state law tax, or for state law, you're still considered an LLC in the state of Colorado. We don't change anything with that. All we do is we send some forms to the IRS stating, hey, we want this LLC to not be treated as a sole proprietor anymore. We want it to be treated as an S corporation now.
Okay,
And we will file the taxes
as an S corp.
as an S corporation now. And
So
you
what
won't
are you
schedule,
really?
you're still an LLC.
Okay.
You're still an LLC.
Okay,
I think it's what, legally, like LLC,
versus for,
and then
IRS.
Yes,
tax.
you got your
The
legal,
LLC is legal.
yeah.
S corp is tax. Yes.
Okay.
You can do both.
Because if you don't make that election, right, to be treated as an S corp, then they automatically put you in as a Schedule C
Right.
taxpayer, sole proprietor type, for tax purposes.
For individual proprietor paying the 15.3% self-employment tax, am I correct that 50% of that then becomes a deduction on Schedule C?
Yes. Well, it wouldn't be on Schedule C, it would be on your S corp tax return, but yes.
No S corp, no LLC, strictly
Oh, then you would pay, you would get a deduction.
Half.
You get to deduct half of your self-employment tax.
on
Not on your Schedule C, but on
10.
your deduction,
1040.
your deductions before adjusted gross
Oh,
income,
it's
before age
2018.
for 2018.
Okay.
So you would get a deduction for half of the
For
self.
half of it, 50%.
Yes.
Okay. Still have to-
Yeah.
It's a big number.
Yeah, you get a little bit of deduction, it would help a little bit, but still,
It's a big number.
it's a big number.
Is there anything in the reform for passive income for investors who own, or realtors who own investment property and rent it out, but don't spend the hour, they hire, like we hire a management company, because I don't ever wanna know what's happening with my rental, I just wanna get the check. So I don't spend the 750 hours or whatever, so my passive income lost because of depreciation does not get to offset any of our ordinary income. Is there any change in that for passive income?
We should dive into that. That might be something that we might dive into, because it just depends. Do you mind if we maybe we'll take it offline and
Sure,
we'll do that, because I might need to do a little research. I don't want to advise you
sure,
the wrong way.
yeah.
But I'd
Just
be
so
happy
much
to
of
look at that for
passive
you.
income is just sitting
Yeah.
there waiting to sell the property, I guess. It's gonna build up every year, because I can't take it, because I'm not really a real estate professional as
Right.
with regard to managing the property.
So you haven't been able to take those losses.
Right, and it's a lot,
Right.
because of depreciation.
I'd be happy to look
Okay.
at that for you. I don't know if we'll have time for it today. It's already 10:30. 11:30. It's 11. This says 10:30.
It didn't.
Yeah.
Oh,
Stacy,
that's
this still
weird.
says
We're gonna have
10:30.
to- I saw it up there and I had to look at my phone.
Yeah.
Well,
I don't know, they went the wrong way, maybe, they went the wrong way.
Not yet.
They didn't.
They didn't. Hey, well, thank you so much for,
Thank
you.
for
Thank you.
coming in
Thank you.
today, and yeah, good questions, I
Can I just
appreciate it.
Shoot you an email with my, you'll have my
Absolutely.
email to provide this, so
Yeah,
Yeah,
absolutely.
that would be
Review it
perfect
again.
too.
Yeah, and if you have a card too, if you have any cards, that's fine.
Not yet.
You
That's
have my email, can I'll shoot you an email, or should I give you a
Yeah,
card,
sure.
or?
Here, do you need a
I
card as
do
well?
have,
Okay.
But I need your card.
So I want to set an appointment to
Oh, thanks, Angie.
do it all.
Yeah, let's, I'll reach out, is it okay